Welcome to Alfonso Cajero, Interview Prep, Chapter 1, Walk Me Through a DCF. Discounted cash flow, DCF, is a powerful financial model used to determine the value of an investment based on its anticipated future cash flows. The core principle behind DCF is that money today is worth more than the same amount in the future due to its potential earning capacity. This concept is encapsulated in the time value of money, which suggests that future cash flows need to be discounted to reflect their present value. To begin with a DCF analysis, you need to project the future cash flows that the investment will generate. This involves estimating how much money the investment will produce in the future. These cash flows are usually forecasted over a period of 5 to 10 years and can be based on historical data, industry trends, and financial models. For example, if you're valuing a company, you might project its revenues, operating expenses, taxes, and net income to estimate its free cash flow, which is the cash available to investors after all expenses and reinvestments. Once you have these projected cash flows, the next step is to determine an appropriate discount rate. The discount rate reflects the risk associated with the investment and the opportunity cost of capital. A common method to determine the discount rate is to use the weighted average cost of capital, WACC, which considers the cost of equity and the cost of debt. The WACC takes into account the proportion of equity and debt in the company's capital structure and the respective costs of these capital sources. For more speculative investments, a higher discount rate is used to account for increased risk. With your future cash flows and discount rate in hand, you can calculate the present value of each future cash flow. The present value is found by dividing the cash flow by 1 plus discount rate, raised to the power of the time period. For instance, if you have a cash flow expected in 3 years and a discount rate of 10%, you would calculate its present value by dividing the cash flow by 1.10 cubed. After calculating the present value of each projected cash flow, you sum these values to determine the total present value of the investment's future cash flows. This total represents the intrinsic value of the investment. If this intrinsic value is higher than the current market price, the investment may be undervalued, suggesting a potential buying opportunity. Conversely, if the intrinsic value is lower than the market price, the investment might be overvalued, signaling a potential sell or avoidance. Finally, it's important to note that while the DCF model provides a structured approach to valuing investments, it relies heavily on the accuracy of the cash flow projections and the discount rate. Small changes in these inputs can significantly affect the outcome, making sensitivity analysis a useful tool to assess how different assumptions impact the valuation. The DCF model is a valuable tool for investors and analysts seeking to make informed investment decisions based on the estimated value of future cash flows.